Record. All right, cool. So this is actually going to be a combined member meeting and also a Outlook in one. So welcome back, everybody. This is week 15, Outlook number two. We have a lot of price action that is developed. Aside from real world events, the price action is as anticipated. We're going to begin with 6B1, but this is going to be a member meeting slash Outlook. So feel free to jump in, ask questions as we go through this. And then once we're done with Outlook, I'll cut it there and we'll roll on to the next part of what we're going to talk about. Sound cool with everybody?
Yep.
So,
Yep.
all right. So let's do it. We'll start with 6B1 as always. It's the Outlook or the list of pairs that we look at the watch list: gold, uh, British pound, NASDAQ, Dow Jones. And I completely forgot, my bad, bro Tato, to go over like crude oil future trade. I definitely mentioned it at the beginning of the Outlook, but I just didn't go over it. So let's start out like this, right? You guys watched the last Outlook, and did everything make sense? Were there any thoughts on any pairs that didn't make sense, or, you know, based off the concepts that I've shown so far?
So far, everything made sense to me.
Okay.
I'm good on the last outlook.
Solid. All right. So, going into the new Outlook, what we had marked up, actually, don't know why I just did that. Okay. Yeah. So what we had marked up was a price leg, and as we can see, we definitely cleared that price leg high right there. Okay, and that actually ended up being a liquidity draw. So, a couple of things. The first is that in the last Outlook, I explained we were going to perform a liquidity draw. I marked out the actions here, a break of structure on the discount side, and I explained why price would not be breaking the low as of right now because price is not balanced. Well, not only was it not balanced, but apparently we just decided to go ahead and liquidity draw the entire price leg itself, as that seemed to be where most of the liquidity lies that will potentially send us down lower. So because of that, this price leg is no longer valid. So we delete that. All of these highs were mitigated. So, all of the price action, it did balance the orders as we drew higher towards this high here. And then on top of that, I'm not exactly sure, but I don't know if we mitigated this high specifically. Let me see here. But I don't know if that treated as equal highs. It's not really that much relevant, but the more important part is that we perform a liquidity draw of a structural point and we did not break structure. So that was really the most important point here, which I said, like, if the counter analysis was if we do take out the high, we need to see if we're getting a liquidity draw or a break of structure. And that's because if we had a break of structure here, then as I explained in a couple outlooks back from the monthly perspective, the monthly area of interest would hold, and that would send price higher, which would invalidate our entire bias. But as we see right now, what ended up happening is actually the counter analysis where we, foregone performing liquidity draws on the premium side of the previous price or the current price leg. And we ran the structural point, which is the high of our current price leg, now rendered, mute, and we ended up getting the structural action of a liquidity draw. As you can see, we tapped just above it, we created the high, and now we are starting to draw lower. If this had been a break of structure, then that would have invalidated our bias, and we most likely would have looked for price to start moving forward or higher and taking out the highs, in which we would probably want to sit on the sidelines for a bit to see how the market would be reacting, because it would be very interesting trying to catch sells or trying to catch buys in this area because of the balanced nature of this price action here. Does that make sense?
Yeah, that makes sense to me.
Yep.
Cool. All right, so moving on then. So because of that, we basically have a clean slate. We don't have a new price leg forming. What we have, or we do have a new price leg forming, but we are in the actual transition state of that price leg forming. So we just blew out the old price leg where we have everything. So now what we're doing is we're waiting for the next impulse to happen to create a new price leg. All right. And so what that means is we have this high here. So now we need to see, is this going to create an impulse and take out, a previous low? But the subtlety here is that because we took out this point here, the low that we need to take out that would generate our new price leg is not this low, but it's really technically just the last low that was generated. Because this is effectively the last low here, or actually be right here. But this last low here is what led to the break of that high. So because of that, this is the point that we need to see mitigated right here, and it would just be ancillary or complementary if we do take out that low there. But we want to see this low taken out here. And if we get that low taken out there, that would establish that the impulse is, continuing lower and we are getting that bearish price action. But for right now, we're kind of, unless you're aggressive with it and just playing off the liquidity draw, we're waiting to get conservative confirmation that we are going to continue bearish price action as of right now. I would say if we're sticking to the macro bias, then yes, we can play the liquidity draw here. But either way, if we're playing the liquidity draw from the 4 hour perspective, we still need to see a low taken and then a retracement or a correction back to an area of interest or structural action occurs in order to, capture a conservative entry. But if you're looking for a very aggressive entry, it kind of already happened, and it really happened on the 5 minute. Like I said, I rarely do this, but it happened on the 5 minute/1 minute where we got the high broken there, and then we ended up actually pulling back, mitigating about 50% of this price gap here, right? And that is that high there is 358. You can see that's 358, so that tapped perfectly. And then we started rolling lower. So that was like sort of like the aggressive entry. This could have a correction, pull back to something, but I wouldn't really force it. I would just, at this point, I would wait for potential opportunities from the 4 hour perspective, but that's a little deeper than, what the outlook ensues. So let me get back to the regular program. All right. So because of that, like I said, we're waiting for the transition of price action to continue the bearishness, and we will get confirmation that bearish price action will continue once we take out, one of these lows or this low here. And really, I'm kind of iffy on this only because like these lows are pretty much equal. That low is 3234, and that low is also 3234. It's a low, but I don't know. I don't know if it's just the futures chart showing, you know, it's just how it's priced. So I would consider that a low because this is definitely a high, and that would be a low there too. But yeah, it is what it is. So effectively, yeah, we want to wait to see if price breaks this low and then pull back or give us a correction if the price action is balanced, and then go high and then go lower. Now you can also technically enter on the impulse, but remember how I said it's risky to enter on the impulse rather than waiting for confirmation because we don't know when the impulse is going to end and we don't know when the correction is going to occur. And because we are in basically like a no man's land or a very volatile state in regards to the price leg, it's better to hold off and wait. And so I'm emphasizing waiting for the price leg to form before you start looking for entries, especially if you did not get the aggressive opportunity based off of liquidity draw here, or the liquidity draw model. Any thoughts? Any questions on that, I should say?
None here.
Nope.
All right, cool. So that's the outlook on GU. Moving on to gold. I'm going to zoom out here a little bit on the 4 hour. Similar thing. So I talked about, price taking this high. And once this took this high, we did end up getting a break of structure. And I said, hey, we're probably going to look for price to continue into the premium side to give us opportunities. That is exactly what it did. It pushed into the premium and it broke. Not only did it break this high, but after this high was broken, it drew lower and then broke that high again. And then we ended up pulling back into basically nothing here. So now effectively this is just raw price action that's forming. And so there's not really much to say. Gold is just ranging still. It's going to continue to range in my eyes for a minute, unless absolutely something drastic like a black swan event happens. But so we should be expecting, as expected, right? We're going to get a little bit of oscillation around equilibrium until we generate enough liquidity and on both sides of the market, and then we start taking liquidity on those both sides, and then we give the actual move. So not really much to say on gold. All right, over to the Nasdaq. What in the world? They wiling in the real world, but as far as price action goes, as explained in the last outlook, I detailed that hey, just because we took this high and we got the liquidity draw, remember that we are inside of a macro range. So because of that, the sells here were very short-lived. We actually ended up getting another liquidity draw of this liquidity point here. Okay. We ended up getting that liquidity draw, and that is what sent us to the premium side of the market. And that's exactly what I stated was that, hey, just because we got, this liquidity draw, remember we're on the discount side, we may get a response, but it's unlikely that this response is what sends us lower. We first need to pull back into the premium side of this range to see if there's any orders that would help send price much lower. And so we ended up getting sponsored by the real world events where it was led structurally or from the price action perspective based off liquidity draw of this low, which is basically a second mitigation of this price gap here. But the important action is not the action mitigation, but the structural action here, and that is what led to not only taking out the high that took out this high, but then this high, and this high here. So we took out multiple highs in succession, clearing out a lot of discount side liquidity. And so because of that, we have now performed a liquidity draw action. Notice how I said that everything before on the premium side of the NASDAQ range is completely balanced. So there's no area of interest that we're going to go for. So we would need to see price look, we need to look at the highs to see how they're respond or how price is responding at these highs. And as predicted, we ended up running one of the a deeper high inside of the premium, and we performed a liquidity draw on it. So now we need to see if this sustains. We need to see if this sustains. And as far as the liquidity draw model goes, if you're looking for an aggressive entry, you can play it. But if you're looking for a more conservative entry, I would say, same thing. We have to wait until price breaks this low to really show us that there's intent to go lower, and then look for a correction to pull back into an area of interest of most likely and then go lower. But if we are in a range and you want to, look on the lower time frames for possible opportunities, you can do that. That is very valid. We did have a liquidity draw. This is now in the area in which we would want to look for sells, and we could be a little more aggressive. I would say hold off especially if you're looking for the liquidity draw model off of here, because we were on the discount side. And so because of that, you see how we took that high there and then took the low. Yes, we did, create that, but you can see immediately because we're on the discount side that led to price action going much, much higher. So, but on the flip side, because we're on the premium, we're more inclined to have those aggressive plays because we're supported by much more bearish interest on the premium side of this range, as you can see by the response to purging of this liquidity point or this high here. Any thoughts, questions?
Nope.
Cool.
Nope. Understood.
Got it.
I'm good.
All right. Moving on to the Dow Jones, similar sentiment, but remember how I already have it marked up here. In the last outlook, what I detailed was if we were to have a break of structure, the action ended up structural action being a break of structure here, we would enter into a range. Well, we did that. We had a break of structure of that high of the previous price leg. And we then just continued higher, creating the range. And notice how price came right back and got sensitive at equilibrium of this range. So this also is, a subtle confirmation or qualitative confirmation that this is actually a range because of how price is oscillating and very sensitive around equilibrium. Excuse me. And so now what we would be looking for right for Dow Jones is, because we're on the premium side, we want to look for opportunities to continue selling. So similar to the NASDAQ, everything to me during this bearish run was completely balanced. So we would need to be looking for highs or liquidity points in order to assess structural actions rather than actions of mitigation. And so the one that stands out to me right now, if I'm just looking at, liquidity points, that right there is a high. I would see price looking to either draw towards that as a high, and then I could also see, price drawing here. It will, for right now, oscillate most likely, but if we're going to give some sort of action or some sort of impulse, it's going to be to take out one of these highs to balance any liquidity. And then if we're looking for a continuation of sells, we would want to the structural action at one of these highs to be a liquidity draw. But for right now, not sure why that didn't mark out, but whatever. As of right now, what we'll look for is we're just going to sit on the sidelines and wait for price to give us, you know, the action to occur. But yeah, any questions on that, on why we transitioned or so and so?
For the because it's balanced and we're looking for the structural points, are we
So sorry, not structural
looking
points, liquidity points.
okay,
The only
liquidity?
structural point would be really here because we're in a range now. So if we were in a run, then all of these highs would be structural points. So in which the last structural point inside of the run phase of the market that we were just in was this high here. And because we mitigated, I didn't mean to cut you off, but this is a really important point. Because we purged this structural point during the run, that now rendered every single one of these highs into liquidity points. And similar, every single one of these new lows that's created are also liquidity points. The only structural point now is actually the high of the range. Make sense?
Yep.
Okay. Sorry, you continue your question. I don't know if I answered it, but
I guess at those liquidity points, I guess
yes.
I was gonna ask, are we looking for liquidity draws? Like, because we're still assuming this to be bearish, right? Bearish price
So,
action.
okay.
Or are we
So
still kind of looking for sells? Or are we more looking like to go either way since it's in a range?
correct. We're looking for it to go either way because we're in a range. But the bias, underlying bias or like the subconscious bias would be for continuation of sells, and that's because we're in a bearish range. And that's just like an intuitive sense is like, okay, well, we created a bearish range, so uh, we don't want to assume that price is just going to completely blast through all of the bearish price action that was generated as we move lower because that's a lot of liquidity. It's going to have some sort of resistance moving higher into the premium. And because of that resistance, it's unlikely that those orders used to move higher will overcome the orders that have been built up in positions all like throughout this entire premium side of the range. So another way to think about it is think of like at every single price level, there's an amount of orders there. But the primary ones that we're interested in are at the highs of these liquidity points or at the liquidity point highs. And so we dictate to see and how we determine if price is going to, go bearish or bullish is based on the structural action, which it tells us that there was a battle really that happened at this high or at these lows. And so if we look at this high here, before the range was generated, this was a price leg existing from this high to this low. You following?
Yes.
Okay. So because of that, this high here, remember that there's orders resting at this high. And so because price drove up to this high, and then we basically broke structure through it, it means that the orders here were balanced, they were finally balanced, but they were not enough to sustain bearish price action, which means that the bullish orders that were, this is very narrative building, but the bullish orders that were used to balance this high here there's no more orders left to balance it, so they're going to be delivered to another objective. Well, where's that objective going to be? If there's no areas of interest, such as sponsored candle or price gap, it's going to be delivered towards new liquidity points. Well, where are our liquidity points? They're at highs. There's this one, there's this one, there's this one, there's this one, and so on and so forth. So unless this is like a huge pool of orders, and there's not enough orders to sustain or to combat the bullish price action, then price will continue to move higher until, we satisfy the bullish intent, and then we'll, transition to the bearish intent. But as of right now, because we're in a bearish range, the intuition or the logic behind it is that there's enough orders sitting at one of these highs to balance out all the bullish intent and then begin sending us lower. But because we're in a range, we want to be conservative with our targets because we don't know what side is going to win inside of this range. Like what side is going to win out and send us outside of the range towards the anchor point or outside of the range towards the structural point. And then that will transition us from a range into a run. So we'll either get a continuation of the run that was printed before, or we'll get a counter run towards the high and then run higher as such. Does that help clear things up, or that make things complicated?
It makes sense.
Okay. So yeah, so that's what we're seeing right now. We're in a range. So we want to see, are we going to take out this high, or are we just going to oscillate for a little bit and then pull back? Everything is on the table. Right now, we are at the mercy of raw price action. We're just allowing price to do, or we're always doing that, but we're seeing what price is going to do. It can oscillate for as long as it wants, but we don't, commit to the market or look for entry opportunities until we get a clear action at one of these liquidity points, because those are our stable or really invariant points in which we know that there are orders at. But we don't know if there are orders being printed, in this area that are sustained enough to send us higher or lower. We might get chopped up. So we want to wait till price takes out one of these liquidity points. Okay.
Gotcha.
Copy.
Okay, cool. So that's what we're reading on Dow Jones. Now for the big one. All right. So clean slate. I have not looked at crude oil in a very long time. I'm actually going to zoom all the way out because this is just, there's just a lot going on there. Like I said, I rarely do this, but this is one of those cases that I really want to do it. So what we want to look for is primarily understanding the exact same thing from the macro perspective and break it down from a structural actions mindset, right? So starting from the very high here, and I'm because I'm on the monthly time frame, I'm actually going to go back, years rather than months because we're on the monthly. So looking at the most recent, or the highest high of oil down to the lowest low, what I'm seeing is that we're effectively inside of a massive range. Where the reason why I say that, and I'm jumping to, all of this, is one, if we look at how prices starting all the way from the left here, we see that we were running higher and higher and higher, and then we ultimately ended up giving a break of structure of that run at that low here. Well, if that's the break of structure, the only low or the only high that exists here that is relevant is actually this one. It's literally the only high that caused the break of structure. So because of that, that is our high. Now we need to know, when do we transition into the range? And so based off the data that we're looking at, we can see that most likely this is the low that shows that basically is the low of our range existing from this low to this high here. And so once we take out that low there, yeah, come on. All right, whatever. So once we take out that low of the bullish range that we had just generated because of the breaker structure here, you can see that we took that low and that establishes our impulse now. So now we now have an impulse to the low side, or another way to call it from the macro perspective or from the higher time frame perspective, we've now entered into a bearish run. So because the bearish run, this is now our structural point. It was our anchor point, but it's now our structural point. And we're looking for price to, run lower and take out targets that are outside the bounds of this analysis. So because of that, what we want to know now is, when does price begin to pull back? Well, we know that a pullback is sustained once we get a purge of a previous, basically structural point. And so remember how I said, when we're in a run, every single high that is generated, or I'm sorry, a lower high that is generated is a structural point. So what we have here is this right here is a structural point. Then that created a new low that took out the previous low. Then that means that this right here is a new structural point. That created a new low. So that means that this right here is a structural point. And then that created a new low here. And that created this as a structural point. Then we took out this low, or took out that low, created lows effectively. And then we pulled back here, create a new high here, and then that ran the lows all the way down here. Okay. And then after we did that, we end up actually very recently ended up purging the last high here. And so because once we purge the last high here, the structural point really, that is what transitioned us to now being in a bearish range. And that bearish range exists from our major structural point here to our anchor point. And now all of these highs, along with the internal highs, the ones that aren't structural points, are now liquidity points. And so now we have a massive range from the monthly perspective, from this high all the way down to this low. Okay. And so because of that, we're in a ranging market. So that's the framework from the monthly perspective. So now if we go down to the 4-hour, and we see on the 4-hour perspective, we just crossed over equilibrium and we had a major response. So if this is happening on the monthly time frame, where we cross the range on the monthly time frame, this is expected, right? We see that there's very strong intent, bearish intent here, bearish sentiment on just above the premium, or just above equilibrium in the macro range. And what's interesting is that we generated, relatively equal highs here. We generated relatively equal highs here. So that means that we're most likely looking for price to draw higher. But as of right now, because we're in the range, what we could be seeing is price drawing lower to mitigate, or to perform some sort of action that will send us higher. And so the only thing right now that is relevant is the fact that, we took out this low here, we took out this low here, and these are both breaks of structure. All right. And so there's no areas of interest inside of this area. So either because we got, a break of structure here. Oh, actually, this kind of looks like a liquidity draw, to be completely honest, because of the high is actually very weirdly, but it is a high there. So this actually looks like a liquidity draw to me. But we'll see what happens. I'm not trading this right now, so because this is just weird price action. But if this ends up being a break of structure, then the next target liquidity point that we would be looking for would actually be this low here. And if this ends up being a liquidity draw, then price is going to start running higher, in which our targets would be, these highs here. So very brief, but good enough analysis for light crude. Thoughts, questions?
Nope.
Alrighty then. If that's it for the outlook. You guys good on that? And we'll continue on with our meeting.
Yep.
All right, cool. So I'm gonna end this here and we'll go over to Discord.